A very good afternoon to everyone. I am Pooja Verma, Singapore Indian Chamber of Commerce and Industry. It's my utmost pleasure to be here with all of you today, and I'm glad to moderate today's informative session. We have an interesting lineup of speakers here with us today. Dr. Zabar Ali, Mr. Kapil, and Mr. Deve. Dr. Zabar Ali, a chartered accountant with over 40 years of external, internal audit and management consulting experiences globally, is currently the managing partner of Raffles CAs LLP, Singapore, and also the assistant treasurer of Singapore Indian Chamber of Commerce and Industry. Working through the rank and file, starting his initial career with George Ross and Company, Dr. Ali obtained masters in accountancy from Monash University, Australia, and is a member of various professional bodies worldwide. He has represented Singapore on strategic management issues as a speaker and had presented various papers in forums, conferences on varied topics. He was nominated for Lifelong Achievement Award 2010 by Monash University, Australia, recipient of the Hind Ratan Award 2012 Delhi, Lifelong Achievement Award in 2013 by Raj TV Tamil Nadu, and was nominated for NMP Nominated Member of Parliament Singapore. He served in the 2001 Board of Trustees of the Institute of Southeast Asian Studies, Singapore, and was in the Advisory Council on Community Relations in Defense in the Ministry of Defense, Singapore. His other appointments include Charter President of ACCA Toastmasters International and Charter President of Association of Work-Life Professionals, Singapore. He has conducted GST awareness for the Malaysian government departments when GST was first introduced in April 2015. Then we have Mr. Kapil Mahani, Indirect Tax Partner, Kritam Advisory, India. Kapil is a partner of Kritam Advisory, heading India and International Tax Practice. In the past, Kapil has been a part of EY India. He is steering Invest in India campaign by decoding various state and central level incentives. Then we have Mr. Devin. Devin Gupta is a partner of Kritam Advisory, heading Audit and Structuring Practice. In the past, Devin has been a part of KPMG. I would now like to invite Dr. Zabar Ali to open the session with his opening remarks. Dr. Ali, please.
Thank you, Pooja. Very good afternoon, everyone, and thank you for taking time to attend this informative session on doing business in India, Indian tax and other incentives, which is now organized by SICCI in partnership with Kritam Advisory India. I suppose it's in Delhi. International trade is the lifeblood of any economy, and it has begun to play a significant part in Indian economy, reflecting the country's increasing integration with global market. India has well-developed tax structure with a three-tiered federal structure. These government bodies levy taxes and duties in line with the Indian Constitution. We'd like to highlight that government is inviting businesses, especially for the manufacturing of various products and providing incentives in India at both central and state level. Tax incentives are granted to industries to offer more production and distribution. To address this, the government rolled out production-linked incentives called PLI schemes. The goal is to create local industrial capacity, attract FDIs, foreign direct investments, and establish an ecosystem impacting upstream and downstream investors. In addition to the above, the central government at India level is also offering other incentives like a refund on GST, VAT, value-added tax on export of goods, duty drawback on export of goods, SEIS for export of services, etc. There are quite many, which directly and indirectly impact on reduction of costs of the manufacturing. Further, there is reduction in the income tax rate from 30% to 25%. At state level, states are offering reimbursement in the form of subsidies like capital and interest subsidy, land rebate, to relieve burden on expenditure incurred, and exemptions on government payments for electricity duty and stamp duty, so on. There are quite a number of them. There are also non-resident international individuals can opt for existing tax regime or the new tax regime with lower tax rates under the 155 BAC section of the Income Tax Act India. NRIs can also avoid paying double taxation as per the DTA avoidance agreement, which is signed with many countries. Usually a non-resident Indian live abroad but earn income in India. In such cases, it is possible that the income earned in India will attract tax in India as well as a country of NRI's residents. In the Singapore context, of course, your foreign income is not taxed. So with that, I would like to invite Mr. Kapil Mahani from previously, of course, now they have formed a company, but previously from the Big Four, KPMG and EY. Devan is also from the Big Four. Myself from Big Four, Deloitte in Singapore. So I would like to invite Mr. Kapil and Mr. Devan. Please, the stage is yours. Thank you, sir.
Thank you, Mr. Ali. I think Kapil is.
Thanks everyone for this platform between India and Singapore, and specifically the initiative which is taken by Singapore Indian Chamber of Commerce and Industry in sharing the knowledge of what are the new normal ways of doing business in India, wherein the Indian government are providing the incentives, not only the incentives but even the ease of doing business by way of tax and other financial incentives, which they are aligning with the best international practices, so that what is being followed in any international is being followed in India, to have a consistency of practice and ease of business, wherein recently even India, you introduced the e-invoicing in India, which is also aligned in terms of the best international practices. So from that point, I'll start the presentation, and then we can take that discussion from. Is my screen visible to everyone?
Make it presentation mode. Now it's clear.
Is my screen visible to everyone?
Yeah.
Thanks. So primarily, the objective of today's session is to introduce and as well as provide the insights of what is the taxation structure in India. Specifically, I'll be speaking more on the indirect tax incentives as well as the infrastructure which is being provided in line with the best international ways in India. So starting from the perspective of indirect tax. So in India, there are three kinds of incentives as well as the taxation structure in India. So in July 2017, the India introduced the goods and service tax, which is aligned with the international GST principles and the VAT principles, and they customize according to the Indian based taxation system and as well as the business practices which are prevalent in India. So GST is one among the introduction as a compliance for ease of doing business, and as well as align with the practice of international tax structure which is prevalent in outside India as well. So if you talk about in terms of the Indian GST, so Indian GST, when it got introduced, so there are approximately 5 rate structure which are there in terms of India. One is exempted, one is 5%, which is one of the lowest rate for a normal trader. Then the rate of tax is on 12% and 18% and 28%. For a service industry, the maximum rate which is defined under the law is of 18%. And for others, even in a goods industry, that ranges from 3% to 28%. That's all depends upon the category of the goods and bifurcation. Then there is a concept which is called the zero rating, zero rating supplies. So zero rating in India is in similar lines what zero rating means with the other countries as well. Zero rating means when you supply any goods outside India, and that's called an export of goods and services. And similarly, the same principle applies when you actually supply to a special economic zone. So there is a concept in India which is called a special economic zone, which is a demarcated zone wherein it is being formed with the intent to form or to give 100% exports from that SEZ location, and that supplies from SEZ location are being exports. And so similar principles are being given when someone is supplying to an SEZ. It is treated as far as it is they are supplying to outside country, and supplies to SEZ is as good as if you are supplying outside India. So the benefit of zero rating means that you will all get the refund, which we'll discuss in the later slides. So that's about the zero rating in India. The third aspect is about the exemptions. So exemption under GST is a very broader perspective, since there are certain products which are still not covered under the ambit of the GST. The products like liquor, the products like tobacco. So all these products are not presently in the GST ambit and in the petroleum side, and so those products are covered as a non-GST supply, which is not covered under the ambit of GST. And then there are specific exemptions which are being given to certain services as well as to certain products as well. Specifically, the exemption is more aligned in terms of what are the basic necessities of, and so from that perspective, some pulses are being exempted on the goods side, agriculture produce, and as well as from the service perspective, education is an exempted service, which is not a zero rated service. So in India, exemption means that no tax or no tax is required to be paid on that transaction, whereas zero rating means you need to pay tax, but you will get the refund out of it. So there's a basic difference in terms of zero rating and exemption. Since the today's seminar is more aligned in terms of what is the practice and what are the benefits which we will be getting if someone is into the export, doing a trading activity from the SME perspective. So we have aligned our presentation particularly in terms of the benefits from any of the tax which will be arised to the traders, as well as the drop shipment who are doing the drop shipments from India or outside India as well. So under India, if you are an exporter of goods or the exporter of services, so there are certain points which you need to see from the perspective whether when your goods or that transaction will be qualified as an export of goods. So under GST, the refunds are being given when someone is supplying, doing the export of goods. Then if someone is doing export of services, and if someone is supplying to SEC. So there are three only scenarios wherein any refund is being given under the GST principles. There is one exception to it, which is called an inverted duty structure. But apart from that, these are the scenarios, major scenarios which are being covered wherein any refund is being given. So with the respect of the export of goods, so when someone wants to claim that, yes, I have exported the goods, so there are certain conditions that needs to be satisfied. The first primary condition that needs to be specified is that taking goods out of India to a place outside India. So from that perspective, if someone is taking the goods from the shipping or for airway bill, if they are going from the custom procedure as well, then it qualifies in export. And then also one of the condition which is recently added to that export principle, specifically in case of the goods, was consideration should have been received in foreign currency. If you are claiming a refund, earlier, before the COVID period, there was no such condition which was attached to the goods in terms of receiving the money against the goods. The only condition was the goods should have crossed the custom frontier of India. But after the COVID period, they have made some amendment, and now this is one of the prerequisite to claim a refund from the GST authorities in terms of, in case specifically of the goods, and you need to satisfy that the foreign currency has been received against the specific invoice. There are certain exceptions to it, wherein a consideration is not material in terms of receiving in foreign currency, even in Indian currency. The cases includes the Nepal and Bhutan, because the India shares the borders with Nepal. So there are certain challenges in terms of the foreign international. So that is one of the exemption or a concession is being given specifically in case of Nepal or Bhutan. Initially introduced, so that was called as an exempted service because no one is able to receive the foreign currency. But then on the recommendation of the Nepal government, India made certain amendment, and then the relaxation is being given in terms of foreign currency. Now the second aspect, which is more particularly in terms of the export of services. So anyone who needs to satisfy whether my services are being exported or not and wants to claim whether no tax or zero rating, so they need to see and test their services, whether those services are being satisfying the export conditions. So there are primarily the four conditions which are attached. That one, the supplier is located in India, and the recipient, which is the recipient of service, should be located outside India. Then the payment of such service received in foreign currency, which is the prime important aspect. And this condition is since from the service tax times. And the last condition is the supplier and recipient are not merely establishment of distinct person. Apart from this, one of the primary and a major condition which anyone actually misses apart from all this is the place of supply of service should be outside India. So particularly in terms of, so there are certain place of supply rules who defines where the consumption of service is happening. So in a default principles, the consumption principles are based upon the recipient, where the location of the recipient is located, which in majority of the cases are located outside India. But in certain exception scenarios wherein the services are defined, wherein instead of the recipient of service, the provider of service location is important to take that a place, the consumption services. So services like intermediary, banking and financial services. So these services in which, when I take a name of intermediary, all the air travel agents, all the commission-based agents, all the agents which are in regard to assisting the foreign universities, they come into the picture of intermediary, and then their service will not, they are required to pay the tax under the Indian government as a taxable service, although their conditions on terms of exports, the recipient are located outside India. But if this condition is missing, then this will not qualify as an export of service. One important another condition which is understood by certain international players as well, when someone says that supplier and recipient of service are not merely establishment of distinct persons. So normally under the export principles, one important thing which you need to see as well is you can't take a branch and head office relationship as a distinct person to treat as an export of service. If a service is being provided from a head office in India to a branch office outside India, or vice versa, then in that scenario, it will still not be qualified as an export of service because they are not merely establishment of a distinct person. And in that scenario, whenever you are opening any company and with the intent to qualify as an export, and when a subsidiary or holding relationship is the best way to form that relationship instead of a branch and a head office. Because if you go with that concept, then you will end up paying the taxes to the Indian government without claiming the benefit of refunds. So that is a very important point which anyone has to see. Apart from that, intermediary services, which is likely the kind of concept which the business should do. So they should restructure those transactions before forming any company as well as the branch to get the maximum advantage from the Indian government in terms of the exports. The third is the scenario when you are supplying to SEZ. So special economic zones in India, as I've already discussed in the initial understanding, is special economic zones are primarily the area demarcated wherein the goods are being manufactured, and even certain the export is happening from there by procuring it from the domestic territory. Domestic territory is any territory other than SEZ is called a domestic territory. So you need to see when you are supplying any goods and service to SEZ, so that they will be taking the benefit, and you are not supposed to charge any taxes to the SEZ from that perspective. And similarly, if you're not charging, you can still claim the refund. So under the GST, the refund is possible under the exports, but if your services and goods are exempted and your output, you are not supposed to pay your output, then you are not eligible to claim your input tax credit, which is also aligned with the international practice under the GST in almost every country, including Singapore as well. So under the exports, there are two processes in which you can claim your refund. One way which India has recently introduced under the GST with the ease of doing business and without the involvement of the authorities and even the coordination of the consultant is export. When you export your goods with the payment of GST, with payment of GST is more not charging from your customer, so you are utilizing your credits which you have availed on your inputs, input services and capital goods. So you are using all those credits to pay on your output export invoices, and then the tax which you pay, you will get the automatic refund in your bank account without even single involvement of any of the officers or any consultant in between. So this is one of the welcome step which Indian government has introduced, and I would like to apprise everyone that this is one of the seamless way to get the credit when you are exporting goods by utilizing your input tax credit. And it is also one of the not a compulsion that you need to use this concept on all your shipping bills. So it is all as on basis if you can use for 2 scenarios with payment and 2 scenarios without payment of tax. So it is as is basis if you have a credit lying in your the books and you want to avail those credit for getting the refund, so you don't need to approach any refund authority. You just pay the taxes, but it all depends upon how much exports you have in your hand. So the how much, if the more export orders you have, the more exports you are doing, then as quickly you are getting a refund. But if you are not having the quick exports and your exports are after a certain period of months, then we always advise clients to go with the other concept, which is called without payment of GST. And you need to approach the GST authorities for the refund which are being unutilized in your ITC balance. So in unutilized amount means that you have not claimed because you do not have a output liability. Your exports are there, so you do not have an output liability. So your input tax are well. So for that aspect, so there is a formula mechanism that you can take your refunds which are lying in your ITC register, and then that's an electronic ITC register, input tax register, and in that way as well, there is a seamless process. Is the government has given relaxation that if you want to claim the refund of your input tax, then once you file your application electronically, automatically the refunds will get granted. 90% of the provisional refund is being granted on provisional basis, and only 10% of the refund is being kept on hold, so that which will be given after a detailed scrutiny. So you can see that how much trust the Indian government tax authorities are doing on the assessees. So that is a very much welcome step for all the exporter who wants to take the India as a hub in terms of procuring and then exporting to international countries. So this is one of the easiest way then anyone can explore But yes, there are certain aspects in terms of the procedure that needs to be followed. But one of the easiest way, according to the business scenarios, which can be followed by any of the SSE who is into the export of business. Then is with regard to the export of services. With regard to the export of services, as we have already discussed in detail, that what all the conditions that needs to be satisfied when someone is doing the have to claim the under the ambit of export of service. So once that benefit is being availed, then the second important aspect is with payment of GST. So under the export of service, there are two processes, but here the difference is only that instead of the customs, because for the export of services, you do not have to go to the custom channel and file a shipping bill. So in that scenario, both the scenarios are almost same, wherein in both the scenarios, whether you are paying with GST or we are paying without GST and claiming a refund of ITC. In one scenario, when you are paying your GST, from your input tax balance. So you are claiming a refund of the output tax which you have paid on your exports in the first scenario, if you can see this scenario. And then if you, after that payment, then you can file the refund. Filing of refund is again, there is a template which has been given online. Everything is online. So I would like to apprise everyone that there is no concept wherein if anyone is going from a hard copy or a physical concept, everything is being automated from the perspective of filing of refunds. And then once you file your refund, then automatically 90% gets granted, and then 10% once the verification of the documents being done. Similarly, without payment of GST as well, then you claim the refund of input tax credit in this scenario. Then again, the refunds are being filed in a similar way, which we were filed in terms of goods when we have made without payment of GST. But apart from all this, the only thing which without payment of GST, which has to be followed apart from the export condition, is then you need to obtain one of the letter of undertaking approval from the GST authorities, which will say that which is being taken for the entire year, and which gives the benefit that yes, I am exporting and I have a license to export from the GST authorities as well without payment of taxes. So LUT is one of the concepts has to be taken approval from the GST authorities. Then similarly, the same principle lies to supply to SEZ as well. You need to approach the authorities and get the refunds from the matter. So this is about the GST incentives, and the GST principles are being followed under wherein the relaxations are being given to the for claiming the refunds, and as well as in terms of ease of doing business, what is the best way to get your seamless flow for credits as well as the refunds. I would like to apprise everyone that under the GST, there are very few services and the goods on which the GST credit blockage has been given. Apart from that, comparing to the previous indirect tax service tax was there in India, under the GST, maximum benefit is being given in terms of the input tax credit. And even in COVID, there were certain relaxations and incentives which is given in terms of the input tax credit, allowing certain input tax credit on certain scenarios, which was not in terms of general scenario. So now coming to the customs, because any discussion without custom is incomplete, and so I would like to apprise everyone in terms of the custom incentives which are there in terms of the import of goods as well as in terms of export of goods. From the perspective of import of goods, one is with regard to the free trade agreements. The free trade preferential agreements are one of the principles which are the international principles based upon the WTO guidelines, wherein any of the country which are importing from the free trade agreement countries, then they get the relaxation of the basic custom duty on the imports as well. So India, in aligned with those practices, has signed various free trade agreements with. So if you will see, there are approximately 10 free trade agreements and 6 preferential trade agreements which are in force, including with Asian countries, Japan, Korea, Singapore, and SAARC countries, and South Asian free trade countries. The one thing which has to be satisfied in the free trade agreement. So why I'm discussing a free trade agreement? If someone wants to import certain goods from a country, let's suppose Singapore, and that Singapore is a country where in the country of origin the manufacturing is being happened, and they want to bring those goods to India and sell it in Indian market. Then from that scenario, there are free trade agreements which are being signed between India or to claim those benefits, you need to satisfy certain principles. Just before this, there were certain amendments in 2020, which has provided strict guidelines to be followed in terms of free trade agreement, because earlier everyone was taking the benefit based upon the certificate of origin only. But there were certain malpractices which were happening internationally. To align those malpractices, India has introduced one documentation wherein one additional document that needs to be submitted at the custom port before the import is happening about the country of origin and certificate of origin. So that form is particularly replicating the information what has been given in terms of the certificate of origin and what is the value additions. There are minimum value additions which are there, and those value additions are required to be followed from the perspective. So that's about the free trade agreements that needs to be followed when someone is importing any good from outside country. These are very important, specifically to reduce the cost of acquisition of any of the products in India, considering the BCD on certain products are very high. So this will give the benefit in terms of the cash working capital to the products, but that needs to be seen. What is the quantum of exemption? What are the conditions that needs to be followed? If all those conditions are satisfied, then you can claim the benefits of free trade agreements. Then apart from that, this is a free trade agreement. There is a concept called advance authorization. So if you are importing certain products with the intent to manufacture and then export it, then this is the advance authorization is very much important, and which are being claimed by many industries, including the textile as well, wherein advance authorization is a license which is being taken to allow the procurement of duty-free import of inputs. Inputs I am specifically using because for the capital good there is another license which is called the EPCG, but for the input tax inputs, which is the raw material, advance authorization is one of the concepts. So I am just giving you a overview of what are the principles, so that if any of the members of the Singapore Indian Chamber of Commerce and Industry wants to initiate certain activity and they want to understand and they want to see that what are the incentives, if I'll go in terms of the manufacturing, then what are the incentives which I can all obtain from the tax, and what all things are there, whether I'll be eligible of it. First, it is very important to know that these are there, and then important is to analyze whether one can take in their business scenario or not. So from my perspective, I'm just highlighting more from the perspective that these things are there, so that whenever any of the business or any of the business houses or a consultant explore with their client, they should know that these are the incentives which are there when someone is doing a manufacturing or when someone is doing the cross-trading activity between India and any other country, taking India even as a hub for exports. So the exemption is being given in terms of the basic custom duty, additional custom duty, education cess, and anti-dumping duty. So major relaxations are being given in terms of those products when you take the advance authorization. Similarly, the principles as with regard to EPCG. So both the advanced license as well as the EPCG. The EPCG are particularly for the capital goods which are being used in the production of goods which are exporting outside. So the one of the intent and a principle and the condition that needs to be specified after obtaining the license is you need to export certain value. So if I'll talk in terms of the EPCG, then what is the benefit you are taking in terms of, so $1 lakh. So you need to export $8 lakh, 8 times of what you have saved in terms of the duty. So that needs your closure happening, and that is also within the specified period of time. So there is nothing as if that everything has an indefinite period of time. So you can claim all those benefits with that time period. So now particularly talking from the perspective of merchant exports. So merchant exports is one of the scenario wherein the people are doing in terms of procurement without even manufacturing it. And merchant exporter can also claim certain benefits under the Indian taxation system. Wherein the manufacturer exporter, if merchant manufacturer exporter means when someone is procuring the inputs and manufacturing, and merchant means when they are procuring goods from the manufacturer from the premises or from other premises. So in the merchant exporter, there are two principles, because some merchant exporter does not want to involve first taking those goods in their godown and then sending it to the custom. So there are certain benefits which are being given in the even to those scenarios wherein a merchant exporter is mainly involved in getting the goods from the manufacturer and directly dumping it to the custom port in the name of theirs, and then sending those goods to their clients overseas, and then claiming and they do not want to avail the want to take first block their credits and then take the refund. So even Indian government has given a benefit of third party export wherein a merchant exporter can claim lower rate and very substantial rate of duty in terms of these kind of structuring business. So if you will see this scenario wherein a merchant exporter is doing, so what they can do is they can take directly from the manufacturer and then get that shipped into the from the custom side without so let's suppose if a rate of tax on a particular goods on which the merchant exporter is procuring is under the ambit of 28% or 18%. So in a normal scenario, what they usually do is that they procure those goods from 18%, then pay to that vendor or a manufacturer the value of the goods plus the tax. And once they take it and then keep it in their warehouse, and then they send it for exports and to claim the refund of 18% of that tax to the custom authority. So it takes around 90 days of time to get the refund. So from that perspective, it is always a good now if someone has to give the take the benefit of that refund. So in that scenario, they can just take the rate of tax, which is 0.1%, and get the goods directly shipped to the custom port, and there is no blockage of 18% as compared to this scenario. In that scenario, someone has to take the refund in the 90 days time period of that 18% of that tax. But in this scenario, it's only 0.1%. So you save a lot of tax by just doing activity with India, wherein you are more particularly playing a role of merchant exporter by buying it from the manufacturer and selling outside India. So this is one of the welcome step which Indian government has done for the merchant exporter, so that their working capital will not get blocked in terms of the refund. Apart from that, there is another aspect which is of a duty drawback. So from that duty drawback perspective, there are three kind of scenarios when someone can take the duty drawback. One is the scenario wherein a re-export of imported goods are being done. Second is the scenario wherein export of manufactured goods, and third is the scenario wherein I'm talking in more in terms of when what are the conditions which are attached to the duty drawback. So duty drawback is a principle when someone has imported a good, they have not used it, and now they want to export back those goods, and they want to take the benefit of that refund of that duty which they have paid. Duty particularly, I'm talking here in terms of the BCD, because otherwise the GST and IGST. So if someone is importing in India, so there are three duty structure which is being imposed. One is the basic custom duty, and one is the IGST, and there are other taxes as well. That is all depends. Just give me 1 second. Yeah, so from that perspective, re-export of goods, in that scenario, what is the benefit in the Indian government is providing in terms of the duty drawback is that you will get 98% of the import duty as refund in when you export those goods within the 2-year time, and those goods are not being used. So if it is if it is a case of unused goods, then the 98% of the import duty is being refunded to the persons. And in case of used goods, there are certain reductions in the refund of the BCD, which is being given. So BCD is something on which the refund is being from the IGST perspective. There is another principles in terms of the refund of GST, but specifically for the basic custom duty, because that is a cost for any of the importer. So that's how the Indian government has given in terms of the duty drawback rules. So another scheme which is being aligned is with regard to the RoDTEP scheme. Recently, India has launched this scheme which is called a RoDTEP scheme, wherein the exporters are eligible for refund on certain duties which are not the creditable duties. So let's suppose if paint industry is procuring certain goods, and that goods are being used and there are certain raw materials which are non-credibles are there. So in that scenario, what the RoDTEP particularly to give the benefits of certain level of state taxes which are not creditable. So if you see that one first line, exporters are eligible for refund of the impeded central, state and local duties that were not not being rebated and refunded, and refund would be created in the exporter ledger account with customs and used to pay the, so these refunds are being used to pay the custom duties, and these incentives are being given in the form of the scripts. So it is more like a cash. If you have a scripts which you have earned in terms of that RoDTEP, then those duties can be used to pay your basic custom duty. So you don't have to approach the custom authorities. So it is over and above what you are earning. So this is an additional incentive which Indian government is providing when you are doing any export. So then a RoDTEP, a certain amount of benefit is being accrued to you on the value of the FOB, and which ranges from 0.5% to 4.3%. And this scheme excludes certain specific sectors like iron and steel, chemical and fertilizers. And that's the kind of biggest advantage. And there are certain scenarios wherein the scheme is yet to be notified when someone is doing the exports with the advance authorizations, or when someone is an export oriented unit and supplying outside India and they want to claim. So there are certain scenarios which are yet to be notified. There are certain aspects wherein the RoDTEP scheme is not at all applicable. Specifically in case when export of import goods. So if someone is importing and then exporting, so government is not giving the benefits. So particularly it is for the manufacturing industry when you are doing some value addition in India, export through transshipments, export products which are subject to minimum export duty. If someone is subject to export duty, then RoDTEP scheme is not applicable. Now coming to the foreign trade policy incentives, as we have already discussed, the advance authorization and export promotion. So this we have already. So there is another incentive which is being provided under the foreign trade policy is RoSCTL schemes. This is particularly for the textile industry for the products which are covered under Chapter 61 and 62 of the tariff, and even to the made up Chapter 63. And this scheme is seen. So earlier before this scheme, there was a scheme which is for the manufacturers or the exporters. It's called a MEIS, Merchandise Export from India scheme. So this scheme, which is RoSCTL, has replaced the earlier scheme, which was called the MEIS scheme. And now the benefit is being available for the textile exporters who are under the chapter heading 61, 62, and 63. This is a recently introduced, and this scheme will continue till the 31st March 2024. Now I would like to even give an overview of because any discussion without providing the insights about that what are the infrastructure incentives which are being aligned in India as compared to the again the best practices worldwide is in terms of the special economic zone, private bonded zone, and free trade warehousing zones. Now why we are discussing this, now I would like to first give you an overview of all this. That in India, the special economic zone and bonded and even a free trade warehousing zone, so they all have their intent to be formed. So if I talk about in terms of the special economic zone, so in a special economic zones, particularly for a goods industry that is being used when someone is doing a value addition by doing a manufacturing activity in their special economic zone. So there are certain demarcated areas. So if you see the location, so location can be, it has to be notified within the notified permission of local sales. So that area is a demarcated area wherein you need to do the manufacturing, and it is as good as like you are in the foreign trade zone. If you are procuring or if you are supplying any goods from a special economic zone to India, then it is as good as like you are clearing from the customs to Indian territory, domestic territory, and you need to comply everything as good as you comply when you import certain goods from outside India. Similarly, when you supply any goods from special economic zone to DTA, then the DTA person has to pay the custom duty while importing the goods, and then the shipping is happening. And similarly, when someone is supplying from a DTA, so special economic zone, as we have already discussed, then it is as good as like an export, and there is no duty which is required to be charged when someone is supplying in case of exports. Then similar principles has to be seen for the special economic. And comparison to a special economic zone, there is a recent very famous concept which traders and SMEs are adopting. It's called a bonded warehouse. So in terms of the bonded warehouse, what is the benefit of that bonded as compared to the special economics zones? In a special economic zone, there is a specific kind of a area special economic zone, and then special economic unit is being allotted to you. But in a bonded warehouse, you can convert any of your private warehouse into a bonded private warehouse, wherein you will be allowed to procure goods from outside India into that bonded warehouse without even paying your custom duty. So you can even take the benefit of working capital, wherein you don't have to pay the tax if your intention is to use India as an export hub, or if your intention is to use India as and when basis, then when the orders are there to supply in the Indian market, and you don't want to pay the duty upfrontly while clearing and blocking your working capital on the payment of duty of the BCD and IGST. So in that scenario, what is the famous concept which the Indian government has introduced and which is also aligned is in terms of bonded warehouse, wherein any manufacturing warehouse or a warehouse can be converted into the private bonded, wherein even you can use it even for your manufacturing, or even not for manufacturing, you can use even for your trading purpose. The benefit is being given, wherein no duty is allowed to be paid till the time you are clearing from a private bonded to a domestic territory area. And if you want to clear it back for the export purpose, then also the principles are very relaxed. And if you want to do the manufacturing activity in that bonded warehouse, so then also gives the added advantage, so that you need to pay in terms of duty when you are manufacturing in a normal domestic territory area. So if you see the comparison sheet which we have seen, which we have just drawn, is from the location wise, SEZ are more certain as compared to bonded term complex, because there's a specific area in which your unit, you can take a unit for permission for local sales, so though no limit for DTA sales, no limit. So there is a export obligation which needs to be specified, satisfied, and in a special economic zone. So you need to create always a positive net foreign exchange, because net foreign exchange means positive, means your imports and exports, you will also have to see that you're always as a surplus, net surplus on your procurement to the export sides. But as compared to that, there is no condition of export obligations which are assigned to the bonded warehouse. exemption from payment of custom duty. So there is only a deferral in a bonded warehouse. Exemption is not there because till the time you are keeping your goods in a bonded warehouse, you do not have to pay the duty. But that does not mean that it is an exemption. It is as good as like a custom bonded warehouse which has been kept. But there are certain compliance which are required, but that is also not strict compliance. Earlier, there was a compliance of a person that needs to be appointed from the custom side, but now relaxed and very nominal conditions and even the process regulatory are required from the perspective of bonded warehouse. Then from the IGST, which is a taxation perspective on the procurement from domestic supplier. So upfront exemption available, refunds is also possible. So in terms of the procurement from the IGST, then if you are procuring from outside India, you don't need to pay that taxes because you have not cleared it into the. So from the time perspective, how much time you can store? There is no time limit to store the goods. But now in this, there is another concept which is apart from the SEZ, there is called a free trade warehousing zone. So free trade warehousing zones are particularly famous for the traders. When someone wants to do the import and pack it and send it, then on a similar lines of bonded free trade warehousing zones are being formed. Special economic zones are mainly famous in India from the manufacturing perspective, but free trade warehousing zones are particularly famous from the perspective of supplying and doing the cross-border trade and then importing it from, let's suppose, China, and then supplying it to other countries and packing and repacking those goods in a free trade warehousing zone. So there are certain free trade warehousing zones in India like ARSHA, and but there are very few as compared to the special economic zones. But bonded warehousing is a free flow concept wherein anyone and anywhere can be done. The packaging and repackaging can be done in both the scenarios. There is no interest liability on the payment of duty in both the scenarios. Duty deferment, payment of taxes in a bonded warehouse can be done, as I've discussed, at the time of removal of goods from private warehouse. In terms of free trade warehousing, FTWZ, payment of taxes are to be made at the time of clearance of goods into DTA. Further, in case of piecemeal clearance, custom duty would be payable on piecemeal quantity cleared into DTA and not on the full quantity received into the FTWZ. Therefore, custom duty differing by importing goods can be done. Renting and other costs are higher. So commercially, if you see the FTWZ are commercially the costliest as compared to the private bonding, because in a private bonding, you have your own controls on the rentals, bill of entry, a similar concept has to be followed. Then from the perspective of if you see the duty benefits on import, domestic procurement, export of goods under bonded warehouse. From the import of goods side, custom and GST both are exempt. Domestic procurement, you see the custom is not there, the GST is still there. If you are buying it from the domestic market, then the GST will be there. Export of goods from bonded warehouse, now you will get the benefit in both the scenarios similar. Waste is destroyed and exported, waste is cleared into domestic market, then the GST is being applicable, and custom is also applicable as a kind of an import which is happening. Domestic clearance for bonded, similarly, as I discussed, if any waste is being cleared into domestic market, anything which is cleared from that bonded warehouse to the domestic market, it is as good as like import into India. If you are destroying any waste, then also you need to pay the duty to that value. Waste is destroyed into India, clearance of capital goods, re-exports, clearing into domestic, we have already discussed. So these are some of the scenarios which we have already discussed in terms of the taxation. So these three things. Now coming to one of my last topic for this session, which with me, and then Devin will take up the session from state and income tax as well as the question answers from there. So India recently introduced a concept which is called a production link incentives. Production link incentive is from the terminology, if you can see that how much you will produce, then you will get the benefit from that. So India wants that production to happen in-house and make in India concept. And over there, under the leadership of Honorable Prime Minister, it is being said that to boost the domestic manufacturing in India, they are giving certain additional incentives of the kind of investment which someone is peeping in India market in all their manufacturing lines, in new manufacturing lines, and even the benefits are being given to the greenfield as well as brownfield projects, wherein if someone wants to expand in the and do the additional investment in terms of plant machinery, then the benefit is being given in terms of production. So from the production, any incremental production which you are doing from the new investment which you are keeping in the manufacturing lines, except land, then the benefit will be given. So any repair maintenance investment is not allowed. It's only the new plant and machinery if you are doing, and then it's kind of a investment that can be qualified as eligible investment, except land. But building, yes, is being qualified for the investment, and then you need to see your criteria. There are certain industries which have already benefited. One is the electronic mobile industry. Telecom is one. Food processing has already got certain approvals. So the timelines, pharmaceutical, the timeline for filing the benefit, willing and committing to the government has already finished. But yes, there are certain industries which are yet to come in terms of textile, wherein certain benefits will be given in terms of incentive ranging from 15%, and the maximum benefit will be given to the quantum of investment so which someone has launched into that particular sector as well as state. So textile is one among them, automobile is one among them, wherein there are three automobile component manufacturers, and even to the complete automobile industries are being given. It all depends upon the kind of investment which someone is peeping, and then the benefit will be accrued over the period of 5 years to the kind of incremental production, wherein from the base year, let's suppose the base year is 1920, and if you are producing your products in 2022-23, then the incremental production, what is the incremental you have done, that will qualify to avail the benefit in terms of the percentage. So if your incremental production is 10,000 quantity, and then the value, and then the percentage, let's suppose 15% will be given. And then for the next year, what is the incremental from that the last year? So all the incremental benefits or incremental production. So that's why we called as a production link incentive. The incremental production you do, and then you will get the benefit because the incremental is happening on account of new production line. However, I would like to apprise that incremental, whether it will be from the new or the existing, that is a kind of a question, but authorities are giving benefit even for the incremental production from the existing line as well, provided you do an investment of new plant machinery and building. So that's the kind of advantage which someone can attain from the investment. However, keeping the production line same but adding one more plant machinery and building, kind of restructuring that can be done. However, that needs to be seen particularly whether they will be eligible on that scenario or not. It is all subjective. That should be seen on case-to-case basis. Automobile is one sector. Apart from that, there are other sectors as well which are on the welcome move. But these policies are being given broader, and the date is yet to come from the perspective of initiation of the applications. So that's all from my side. And then if anyone will be having any question from relating to the discussions which I have made, then we can do it at the end of the session afterwards. Devin will conclude all the points. Over to you, Mr. Devin.
Yeah, thanks, Kapil. But Pooja, you can't start the screen while other participants. Okay, Kapil, you need to stop.
Let me stop this.
Is my screen visible?
Yes.
Yeah.
So I think the objective which we're trying to address here is my voice audible, right? Yeah. So the objective which we're trying to address through this webinar is that how directly or indirectly tax is going to have an impact on the overall production as well as on the overall incentivizations which you can get from the Indian market, right? So be it be a manufacturing, be it be a trader. So we have discussed the indirect tax benefits, which is called VAT, GST, which is directly or indirectly having an impact on the manufacturing of the goods. Now we are going to talk about the state level incentives. We're just going to highlight these incentives. These incentives provides 2 or 3 kinds of a common support, which every company, manufacturer, probably trader also can avail these kinds of benefits. So we have taken the 3 states case studies rather than taking a whole India. It is not possible. So in this, what we might like to highlight is that when we go for setting up a unit in India for the purpose of manufacturing, be it be automobile or be anything, right? So government is giving you additional cash incentive of 15% in a form of capital subsidy of the plant and machinery. So for example, if you invest $100, just taking a rough example, so government is paying you back $15, provided you produce the copy of the invoices and documents to the authorities. They will give you 15% as an incentive in your bank account, which will be generally paid over a period of 2 to 3 years, right? So it vary from state to state, but probably the concept is that government want to give you additional cash so that you will come up to the market and start doing the manufacturing. In the past, like from China, recently one of the telecom product manufacturer step into the UP market, Uttar Pradesh market. So those incentive has been offered to these companies. Second sort of subsidy which the government is giving is in the form of interest subsidy. So let's say if you are taking a loan from the authorities in the form of the dues. So let's say there's a dues payable by a company to authorities close to $1 lakh, right? So in that say, the government will say we will charge you 5% of rate of interest rather than the market rate of interest. If the prevailing market rate of interest in the market is say 12%, so you need to pay 5% as a interest cost to the government. So these are the incentives which indirectly reduce the overall cost of the product and make the profit venture profitable. Third is that whenever you go for any kind of acquisitions in any country, in any part of India, we need to pay stamp duties also. So government is saying that if you buy a land or on a lease, there's a stamp duty attracted at the rate of 8%, 6 to 8%. So that is also being waived off if you do a business in the specific states. So these are the incentives offered by the states, not by the government of India. So every state is become like one of the entrepreneur and offering the best services to the companies. And if we see the trending states, so these 3 trending states are the top 3 states of India where the companies are coming and doing their businesses, right? So next points which we like to highlight is that if you go for a filing of the patents, right? So that also being the cost of the patents also being reimbursed by the government, right? And if any taxes, like say GST is paid in these states, so government is going to refund you back those states. I'll give you one simple example, it make you very clarify. So let's say if you purchase a plant and machinery of $100,000 and you pay a taxes on those $100,000. So government is saying that we will reimburse you back these taxes which you have paid while procuring these plant and machinery. So again, on the electricity, say from the electricity perspective, that if you do they will waive your electricity duties, because when they provide you with the electricity, they charge you the taxes. They're not making your electricity cost free. They're saying whatever the taxes are there on the electricity, that will be waived off. And same way with the production link incentive scheme also, that if you do the manufacturing in the specific states, they will give you the additional incentive, because production link incentive scheme is offered at the central level. So there are two structures. One is a central structure, second is a state structure. So state is saying that we are going to offer you the additional 1% incentive if you do the business in Karnataka. So this is more of the impact which we would like to highlight from the indirect tax perspective, which indirectly going to impact the manufacturing cost of the product. Now I would like to highlight few incentive from the direct tax perspective, which makes any assessee who wishes to do the business in India, irrespective of the fact whether assessee is a trader, assessee is a manufacturer, assessee is doing the marketing business in India, assessee is doing the support business in India. So presently, if we see the tax structure in India, for a foreign company, the tax rate is 40%. In foreign company, let's say if you are based out in Singapore and you want to do the Legion office business, then the tax rate will be more than 40%. So what India is promoting now, if you set up a business in India via holding subsidiary structure, then the tax rate will be 25%. And if you do a manufacturing setup in India, then tax rate will be 15%, which is 15% plus surcharge, which comes to 17%, which we are like to highlight here. And earlier it was close to 33%. So these are the few incentives, which is again, whenever you do any kind of a business, these are the incentives on the profits, not on the manufacturing of the goods or manufacturing of the services. So these are the additional vanilla which government is trying to give, so that it becomes a cheap country for doing the business, as well as on the higher profitability there will be less tax, right? And additional benefit which they are now giving is the dividend distribution tax. Earlier, dividend distribution tax is the cost for the NRIs. So let's say if you are a Singapore company and you want to take a dividend from India, and let's say if the Singapore company is doing a business of $100 in India and the cost is, let's say, $60, on $40 of repatriation, the company need to pay $8. So ultimately, the company left out with the $32 of the amount in the Indian account, which can be repatriated to Singapore. Now, since the dividend distribution tax has been abolished, this is giving an additional benefit to the company who are based out in Singapore, that they can claim this $8, which what they have paid in the form of dividend distribution tax, as a tax credit. So again, this is a wider subject, but I just want to highlight here that dividend distribution tax has been abolished, and the company based out of Singapore need to pay the taxes on the income arising from India, and they can claim the DTAA benefit in their country. So this is the main two significant impacts which is there from the direct tax perspective. And these are the few FAQs which we want to address, which we have seen in the past, and which is directly indirectly going to which we were forcing from the international market, that these are the few common questions. I'm not saying these are all the detailed questions. So the first question is whether the refund whether these refund which you are getting is going to reduce the manufacturing cost. Yes, because ultimately if the taxes is not being charged to the customer, you will be at the low competitive prices and customer is going to buy it from you. So for example, let's say if the GST is being refunded, so let's say there's a product of iPhone, which is a $30,000 phone. Oh, sorry, not 30,000, let's say it's a $100,000 phone. And if 18% tax is there, so your phone will cost you $1,180 as a cost of the phone. Vis-a-vis, if it is case of an export, then there will be no tax of $180. So $180 will be saved, and the phone will cost you $1,000. So this is the incentive which is being offered. Now the second thing which we have tried to address is that whatever these refunds we are talking about, which you are getting from the government, are those manually driven or is it through automatic routes? So since earlier it was a more of, with the change in the economy and with the change in the style of doing the business, the government is now offering all these things on an automatic mode. So you don't need to rush to the offices of the tax office. You just file it online and you will get a refund automatically in your bank account. So these are the things which make more attractive to enter into the Indian market and do the business. the next things which we need to address is that what is this drawback and SEIS incentive? Is it on the top of it which we are getting, or is it the same thing which we are getting? So when we are saying that you are going to get the refund of GST as a tax, it doesn't mean that you will not get the drawback or SEIS benefit. You will get these both the incentives. So drawback is generally for the manufacturing and exporting them, and SEIS is more like a export of a service. So we are saying this is an additional incentive which the government want to pay you back in the form of 4 to 5%. If we talk about in Indian market, all the textile companies are dependent on these drawbacks, because ultimately the margin, significant margins, lies on these drawbacks and SEIS, considering the international competition in the market, right? And when we are saying that this PLI, this production link incentive scheme, what is this? So now this scheme is nothing relationship with the drawbacks and the SEIS. The schemes is more on the production, irrespective of the fact you sell those goods in India or you sell those goods outside India. They are saying that we are going to give you an incentive of 5 to 6% on the manufacturing of the goods. So if we see the overall analysis in the past, I think there are three sets of incentive which government want to give. One on the production, which is called production link incentive. Second, on the exports, when you give an export, they will give you additional incentive because you are bringing foreign currency in India. And third incentive is like whenever you are paying any kind of taxes during this journey, that will also be refunded back. I'll give you one example of a Dubai market also, that if you visit in a Dubai as a tourist, and if you do any kind of expenditure in Dubai market, and at the time of exiting the airport, at the time of exiting the country, you produce those invoices at the airport, and you will get the refund of those money. So that's what the same government want to say, that if you are taking the goods outside India, you don't need to pay any kind of a taxes on that. You just claim those refunds. So this is the same concept India is being now followed. And another thing which we are saying, that after doing the business, whether there is any tax on repatriations of funds. So this is a common question which we are saying, that if there is a profits coming out of Indian entity, what will be the implications when these money is going to take out from India to Singapore? So let's say you are doing a business in India, you bought a product or you manufacture a product of, let's say, $500 in India, and the selling it those goods either to India market or to a global market at $1,000. So you are getting a profit of $500. Now it's up to the company whether they want to reinvest this $500 in India. There will be no tax. But if you want to repatriate this $500 to a Singapore company, you can do this $500 repatriation. No tax will be charged. Only that income will become the income of the Singapore entity, and Singapore entity will need to pay the income tax on those profits which they have earned in India. And ultimately, earlier and now the significant change is like there's no dividend distribution tax on that $500. So whatever the tax you are going to pay in India, you will get the relief under DTAA in Singapore also. So this is again going to save the significant cost of the companies which are doing business outside India with India. And one thing which we would like to highlight, that whenever you want to step down to an Indian market, the structures available in Indian markets are either a private limited company in which tax rate is 25%, or if you do a manufacturing in India, then it becomes 15% in India. And another structure is a limited liability partnership, wherein 30% is the tax rate, and the third is a foreign company, which is a 40% tax rate. The foreign company generally comprise of branch offices, generally for capturing the orders or for showcasing that you are having a presence in the global market, and just as a branch office, they are not allowed to do any kind of a trading or business activity. So this is about the few FAQs which we tried to highlight. And one thing which we have tried to cover in this FAQ is that if we form a company in India, whether any resident director is mandatory. Yes, you need to have at least one director from India. So whenever you are stepping down a business in India, you need to have one person who will be the signatories, and every positions he need to do. For that, we need one director. So you can form a company in India, keeping one international director and one Indian director. And you can, it's a minimum requirement of a 2 director. You can keep more than 2 directors as well. And whenever you do any kind of a company structures in India or do any business in India, these are the basics law which every company needs to comply. One is the Companies Act, second is the Income Tax Act, third is the Provident Fund Act, fourth is the GST, and fifth is the FEMA. Again, there are several laws depending on the product and nature of the business, but these are the common laws which every company need to comply, irrespective of the fact whether they are doing the business or not, or they are just opening the office as a marketing space or not. So that's what we would like to cover in the form of FAQs. So if I think this is the end of my session, and if there are any questions which we would like to address by the attendees, we are happy to take those questions.
Well, all the participants, those of you with questions, probably you can address it to Mr. Devan or Kapil, who have done a nice presentation. I have one question that's being raised by one of the participants. What about the services rendered by a subsidiary company, and the company only renders marketing, and they are trying to introduce the product of holding company? So do they have zero rated, or what is the tax structure in this situation?
So I think from the perspective of the marketing, so till the time, so it is outrightly, if I have to say, in terms of the marketing, if they are doing only marketing activity, then it is an export of service. But if of marketing of service, if they are doing, but if they are doing in products, then it all has to be seen from the custom side. But if it is purely a service company or marketing and earning a marketing fee from that, then it is no GST and exports are there. But having said the same, we also need to see if marketing is being coupled up with some kind of coordination and even a negotiation with the customer, then it comes the flavor of intermediary.
Right. What about registering as representative office? Because to my knowledge, if you can register a rep office and you can do these marketing activities so long as it's a NRE account, right?
Having said the same, since I have also mentioned in my discussion that's the kind of structuring that has to be seen. If you are doing you are making as more of a representative and a branch office of a Singapore company or from any other location as well. But if you are supplying those services to your head office, then they may not qualify as an export. So it is very important that when you structure any company, then you need to see that it's not only from the one angle, but have from the 5 side of the corner, export, companies, income tax, so that you will get the maximum benefit out of any of the structure. And that can only be discussed on case-to-case basis.
Right, great. The next question is 90% upfront refund is done and 10% on verification to refund zero rated GST. At what rate the service provider has to pay, even if they are not collecting from overseas client?
Can I take this answer? Can I take this question?
I think no, there was a mention that 90% is refunded, right?
So, sir, okay, let me clarify you here. Yeah. What law says, if you are a service provider, right? I take a rough example. Let's take an example of this marketing company which we were talking about. So marketing company use the services of LinkedIn or use the services of Google, and they are paying some taxes to the Google and to the LinkedIn. So whenever they paid those taxes, now ultimately they are going to charge this amount to the company based out of Singapore, right? That sir, I have done this for you. I'm going to charge you $1,000, right? Now, when they're going to charge $1,000, so the first question is addressed whether it is an export or not. So we are saying it is an export, no need to pay the taxes. No need to pay the taxes. Now, in the discussion, we have mentioned that when you have made a payment to a LinkedIn or to a Google, whatever the taxes you have paid, the government will give you the refund for that, because you are exporting the services, not the taxes. So government, whatever the charges, let's say in LinkedIn you have paid $500 and to a Google you have paid $100. So on $600, let's say a rough rate of taxation is 10%. So $60 you have paid a tax to the LinkedIn and to the Google. You go to the government and ask that please refund my $60 which I have paid to LinkedIn and the Google in a form of the goods and service tax. So the law is saying that 90% refund of that $60 will be given without asking a single question, and balance 10% will be given once they see the documentation of the company, whether actually you made a payment to a LinkedIn and to the Google. So this is what the law wants to establish, that we are relying on the statement of the company. But however, we are making 90% release on what you are saying. 10% will be released. Really made the payment to the Google and LinkedIn, and in return you have exported this services of $1,000 to outside India.
Okay, so just follow up on this question. I hear that the refund will take about 2 years. Why is that it takes 2 years for the refund? I remember Kapil was mentioning about the refund.
I think so was some misunderstanding. So there were two aspects. One is that you can take a refund, and there is no from the point of view of claiming refund. Yes, there are timelines. That it's not that if you are sitting in the month of this October and you can claim the refund of 2017. So government has given a timeline that up till this timeline you can claim a refund of your input tax which are being blocked. So it is also for the benefit of the companies to take the refund within a period of 2 years rather than holding it for and waiting it for the 5 years period. So from that perspective, the government has given a timeline. Take your refunds. Why you are keeping with us? But there is always a timeline.
So basically, it's a timeline, not that income tax takes 2 years to pay you the refund.
No.
Yeah.
So in fact, that's what I was also trying to explain, that under the GST, this is the first time in the indirect tax. The government is giving you without even asking you a single question.
That's great.
That's the kind of thing, and wherein no involvement and even of, provided you do the best structuring within your company in terms of documentation and review happens regularly, you will get seamless flow without even the intervention of the authorities, and you don't need to follow up with the authorities for that refund.
The next question basically is, how safe is it to do business in India? Basically, this participant would like to start a social enterprise, but he is concerned about the safety, political stability, and all these bribery issues. So can you just enlighten this person? Yeah.
So I think from the perspective of the how safe it is to do business in India, my question can be well answered based on the credentials which India already have in terms of the companies from across the globe which are coming in India. And so there is never a thought, because India is a consumer market, and anyone who is entering into India, they enjoys the benefit of that consumer 1.3 billion in consumer market. So that's the kind of advantage that any of the industry, and in fact, I would also like to apprise that from the startup space, India is one of the fastest growing startup space economy in the world. So from that perspective, any startup or any of those companies are only coming with the intent of consumer driven market, and how safe in terms of the tax policies all aligned in terms of the then if you do the things in terms of incorporation, from opening a company till doing your business, so everything is automated, so you don't need to go to any of the authority to take permission. So that's the kind of a benefit which has been there under the Modi government. And from the possibility, I can very well assure that under the leadership of Honorable Prime Minister, that is a kind of political stability, and also the people listen to you. So in fact, it's not that a policy is being drafted that cannot be changed. In fact, we have experienced multiple times when we have made the certain policy change in the Indian government, because there were certain loopholes, and as well as there were certain the drafting issues, and that was hampering the industry players and the authorities at ground level interpreting at a different level. So even the ministry at finance are looking out and even listening to those issues and giving clarifications for the public clarity at large, and even directing their authorities to follow the principles. So this has never been done in the past. I've never seen wherein the government is aligning with the business, because they also understand that we have to follow the business rather than business has to follow the tax. So that's the kind of best business practice which Indian government is following. And that is why the result is that Invest India, which is one of the noble organization, they are being now chairperson for the international community.
I see. Okay. Next question is, if there are some fraudulent refunds being claimed, what is the control that they have right now in place?
I'm sorry, I'm not able to understand.
Sorry, Kapil. The question is, if there are refunds or claims made by companies fraudulently, what are the current controls the government has, and how do you stop that? Because there may be fraudulent claim of funds, and were there some instances recently or in the past after this new laws is enacted? Yeah.
So since under the GST, everything is more of automated and data driven as compared to the previous indirect tax, when state laws and central laws were different and there was no intermingling and no sharing of data between the two.
Okay.
But now with the GST being introduced and with the concept of e-invoicing being introduced in India, everything is from the start, which is the e-invoicing, till any shipping of the goods, again, which is called the electronic e-way bill. When someone has to send the goods of any particular value, then there is a requirement of e-way bill more than 50,000 INR. Then they need to raise the e-invoicing along with the e-way bill for the transportation. So from that perspective, the data which is at a central level is more robust.
Okay.
And they have the chain linkage from start to end. There might be a scenario that they may come after 2 years or 1 year, but it won't be possible that they will not come to you if you are doing in a fraudulently activity. And that is the reason there are strict provisions, strict penalties has been in compliance with the countries wherein a strict penalties has been imposed. And strict penalties means that people are fully aware that if some of the kind of fraudulently activity has been done, then there is always a strict penalties, and even the manhandling has been done under the tax provisions.
I see. Okay. Because now it is all digitalized, so I think there's no question of fraudulent happening from time to time. Yeah.
Yes, if you see that in any of the country which has introduced e-invoicing, so there is always, so let's if you see the past credentials with even the Europe and even the America, which started with the e-invoicing, the purpose of e-invoicing was also to reduce the kind of malpractices. And any country which has introduced e-invoicing, they have also reduced. And in fact, since I was personally a member of the e-invoicing which was introduced in India, and I in fact authored a book on e-invoicing in India. So we were fully aware that how that structuring happens in terms of e-invoicing, and what are the principles which government at a data center. So there is a strong data analytics team which is working day and night to see the chain linkage of any transaction.
Okay, that's great. So probably we will take another 1 or 2 more questions from the floor, from the participants, if they have anything related to today's session.
There is one more question. They are saying, what about the services rendered by the subsidiary company rendered only for marketing, introducing the product of holding company.
That's being answered already, Pooja.
It will be under 0 rated because that person has written a long question.
Kapil, can
So
you
what
just
about the
reiterate?
services? What about the services rendered by a subsidiary company rendering only for marketing or introducing the product of holding company? It will be 0 rated or not? My another point is that since it is a subsidiary and holding relationship, I would like to clarify that if you are doing only the marketing activity, marketing does not involve in terms of negotiating the clients and doing the business and then making the possible clients. If it is purely identifying the possible market, then it is covering under the ambit of GST, because there is a very thin line of difference between a marketing and an intermediary. So you need to see your contracts and you need to draft your contracts very carefully so that you will not step into the shoes of intermediary, although you might be a marketing as well. So for the marketing, the answer is yes, 0 rating. But for the intermediary, answer is no, 0 rating, not.
Okay. Any other questions? Anything else to add on?
I think the questions are being done, and in fact, as Pooja has already mentioned, there any questions, if any, oppose this session can be entertained via chambers.
Yes, yes. Pooja, so can we end the session or?
Yes, sir. We don't have any more questions. The audience who wants to connect with Mr. Kapil or Mr. Deven, they can just email me. I will get them connected and help you answer your queries. So I request Mr. Zabar Ali to close the session now.
Okay.
Mr. Zabar Ali, please.
Yes, yes. Thank you very much, Kapil and Devan. It is a good session and something that Singapore participants have learned today of setting up businesses in India, and especially when there are a lot of incentives given by central and also by the state governments. So obviously, if there are companies who are keen into venturing into India, of course, Singapore Chamber of Commerce, Indian Chamber of Commerce is there to help, and probably we shall be having some trade missions where participants or the members, I encourage participants who are not members to become members, and probably you can join these trade delegations to India. So there are quite a number of trade delegations that we have decided that we will take on once the COVID period is over, and hopefully Singapore companies would benefit through these trade missions and get all the necessary information. So with that, I will again thank both Devan and Kapil for giving us an opportunity to highlight all these opportunities from the tax point of view. And thank you for attending. Thank you, Devan and Kapil. Thank you for participants. Thanks. Have a good weekend.
Thank
A pleasure, and always
you.
like to speak on this platform and sharing the knowledge with people like you, seniors, and the chambers.
Thank you. Thank you.
Thank you.
Thank you. Thank you.